Disclaimer: this video is for informational purposes only and should not be considered financial advice. Always do your own research and consult with a financial professional before making investment decisions. Inflation came in hotter than expected. The Consumer Price Index, CPI, just surprised the markets. Let's break down what this means for your investments. Month over month, CPI jumped 0.5% versus the expected 0.3%, while Core CPI rose 0.4% versus 0.3% expected. On a yearly basis, inflation hit 3.0%, slightly above the 2.9% forecast, while Core CPI remained sticky at 3.3%, higher than the expected 3.1%. What is CPI? Why does it matter? CPI, or the Consumer Price Index, tracks the cost of living, your groceries, gas, and rent. When inflation runs hot, your paycheck buys less, and the Fed takes notice. Core CPI, which excludes food and energy, remains at 3.3% year over year, showing that inflation isn't cooling as fast as expected. A hotter than expected CPI means the Fed might keep interest rates higher for longer, impacting everything from mortgage rates to stock prices. Market impact: who wins and loses? So how is the market reacting to these numbers? Interest rates. With inflation running hot, the Fed may delay rate cuts, pushing them further into late 2025 instead of mid-year. This means borrowing costs stay high, affecting credit cards, mortgages, and business loans. Stock market. Higher inflation is bad for tech and growth stocks since rate cuts now look unlikely. Sectors that could benefit include energy and financials, while rate-sensitive sectors like real estate may struggle. Bond market. Treasury yields spike higher as traders price in fewer Fed cuts. Short-term bonds may remain attractive, but long-duration bonds could see more downside. Currency market. The US dollar strengthens as traders expect the Fed to stay aggressive. This puts pressure on emerging markets and global commodities. Investment strategy takeaways. So, should you adjust your investments based on this CPI surprise? With inflation staying hotter than expected, consider holding inflation-protected assets like commodities or TIPS, Treasury inflation-protected securities, energy and financial stocks, which tend to do well in inflationary environments. Short-term bonds. As long-term bonds could struggle with high rates for longer, be cautious with tech and growth stocks, as high rates weigh on valuations and rate-sensitive sectors like real estate and utilities. Bottom line, inflation is not cooling as fast as hoped, so expect more volatility in the markets ahead. What do you think? Will the Fed delay rate cuts further after this CPI report? Let us know in the comments. Hit like and subscribe for more real-time market updates.